saved money for your home down payment, and there are other investments as well, and now you've zeroed down on your home. Now, how do you tap these various investments to raise money for your down payment? Well, that is the topic of this video. Welcome to Fund to Money, your 24 into 7 buddy for all your money matters. How to raise money for a down payment, even if you have been investing for quite some time, is always an issue. This video intends to talk about it, give you some thumb rules and tips. Wait for just a little longer. Tapping your investments for your home down payment can be something on which you might be scratching your head. Which investment should you touch? Which investment should you tap first, liquidate first, redeem first, and which you shouldn't? Or should you do everything, go for the broke, tap every investment and raise the money? What is should be the approach when you are raising money for your down payment? We are not talking about saving for your down payment. That's a topic for another video. But here we're talking about investments. You from the money or the money that you already have. How do you raise money for your down payment? So there are some basic tenets that you need to keep in mind, thumb rules. And there are probably three that we can think of. And here comes the first one. Now, you would be having a home loan interest rate. You will have a rough idea what it's going at. And when you're planning your home purchase for your down payment, what you need to make sure that you tap those investments whose returns or interest rates or whatever, basically the money that you're getting, what those investments are earning annually, is the post-tax returns of that is lower than the post-tax effective rate of home loan rate. So suppose there's a home loan rate of 9% and roughly take a thumb rule of 30% tax that you are there. So you deduct it and you would probably come to something like 6.3%. I mean, these are back of the envelope. So anything that's giving you lower than 6.3% post-tax, whether it's an interest bearing or a capital gain bearing, those need to be liquidated. The second thing that you need to keep in mind is there a cost of using that investment? So most of, or shall I say, most of the longer term investments have a cost of liquidation. So basically what this means is there could be surrender charge, there could be an exit load. The idea is to make you stay invested for a long period of time. So when you're using that money for your home down payment, you might have to pay this charge. Now, it might may not make sense to liquidate these investments at all, simply because if these charges are high, because you're losing out a lot of money from the growth. So you need to keep in mind whether you're having to pay a lot of an exorbitant charge for using that investment, making a premature sort of exit. Surrender charges are there in life insurance policies. Life insurance investment policies. Exit loads are there in some kinds of mutual funds, given certain conditions. So you have to keep them in mind. The other is about future returns. Now, you need to keep in mind that the investments that you've made, do they have a potential for delivering high returns? It might just be that you are liquidating your best bets for the future, best options for the future, and that may not be warranted. This is typically in the cases of high growth investments like stocks, equity funds, investments that have been doing well. You actually are selling them off when they're just about to take off. So you need to make a very good assessment how those things are going to fare. So these are the three things, larger things that you need to keep in mind. Now here is what we think should be the sequence. The first thing, sequence of tapping your investments for your home down payment. Now, number one is before we begin the sequence, there are certain items which you should not touch. We strongly recommend that you should not touch. One is Provident Fund. We know very well that you're allowed to withdraw money for Provident Fund. When it comes to housing, you should not do it, simply because it's one of the most tax tax advantaged investments for retirement. You get it's tax free all through at the contribution stage, interest and maturity. Most people who withdraw money for provident fund in India, they don't replenish it. As a result, when they retire, they practically have nothing in terms of provident fund balance. Even a couple of lakhs will be nothing for you for your retirement period, because the costs would have gone up so much more. So while you're allowed to do certain things like a partial withdrawal from public provident fund, please don't do it. Try avoiding it, because most of the time people don't replenish that money. It is sometimes difficult to get that growth back that you got. So you should have ideally made separate provisions for your home down payment. So that's number two. Number three, things that you shouldn't touch are life insurance policy. Remember, if you liquidate that policy, life insurance cover also goes. You get that cash, the cash value or whatever value that you have of the life insurance policy. You might end up paying some kind of a surrender charge or penal charge. Apart from that, you are not covered. So if you are doing that, obviously you'll have to buy some kind of a life insurance cover, probably a term plan. Don't do that. It's not a great idea. With life insurance policy, remember, if within a certain period, if you have made the surrender, it's earlier than a certain threshold period, the income tax deductions that you have taken will get added back. That amount will get added back to your income. It's not a fun prospect. So keep that in mind. After that, here let's begin with the sequence. Anything which is a sort of interest-bearing debt fund kind of a thing, those are the kinds of investment that you should be tapping first. You need to liquidate them first. The parameters we have given before. Then you move on to higher growth investments. You take a good look as to whether they have a potential in the future. If they have, try to restrain. There would be investments which are not doing well. You liquidate them. This is the best time to underperforming or investments that have run the course. Liquidate them, use them. What do you do if this whole process still doesn't raise enough money for you? Now, we at Fund Only would suggest that you go for a loan against FD. It will be like a bridge fund. You can get a loan. This is for the slightly longer term FDs. If you have one, you can raise money against such an FD. You'll be getting it for 1 to 2 percentage points higher interest rate, and you can take that. But anything else, you can obviously take loans against other assets. It's not advisable, but it's likely to be more than the home loan rate. But above all, what you need to keep in mind is that you really need to go for this kind of a purchase. Maybe obviously you cannot afford it. You probably need to go for a home which is more affordable. So you bring down your budget a little bit, or postpone your purchase a little bit, so that you can be better prepared. How did you find this discussion? Was it useful? Please use closed caption option in this video to get the highlights, edited highlights, both at the captions and also in the description section. You get useful links out there. Stay connected with us on all leading social media platforms.